Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another Economy and Finance 101 video, this time on bonds. So what is a bond? So I'll start with a few definitions. We've had many questions from you out there about the bond market, but there's just so much to say that it didn't fit into just one short video. So let's start with the basics, and over the next few months, we'll be adding some more specific videos to address the wonderful world of bonds. Before we get started, a special thank you to Hugo Nouri from IA Investment Management for helping us putting this together. So let's get started. Okay, so what is a bond? So a bond is a fixed income instrument. Fixed income meaning that when you buy a bond, you know exactly when you're going to get some distributions, when you're going to get some return from that, and it's fixed through time. Represents a loan made by an investor, so the person who buys the bond, to a borrower, so the person who sells the bond, and typically corporations or governments are the ones that sell bonds or that borrow from the public in this way. So a bond can be thought of as an IOU between the lender and the borrower that includes the details of the loan and its payments. So there's a specific contract with dates and amounts that will be distributed to the borrower, the investor rather. Bonds are used by companies, municipalities, states, and sovereign governments to finance projects and operations. And these securities pay an interest coupon generally semi-annually and pay the face value when the bond matures. So let's say you buy a bond for $1,000, you know exactly when you're going to be getting coupon payments through time, and then at the end of a specific period at a specific date, your money is sent back to you. So that's what we mean by face value when the bond matures. So maybe to put things in perspective, and maybe will surprise a few of you out there, the bond market is the biggest market in the world. So when we think about the market or financial markets, we tend to think about stocks. But the global bond market is $128 trillion in 2020 data. That's what we had. And the global stock market was at close to $94 trillion. So the global bond market is larger than the stock market by a wide margin. So many types of bonds, many types of fixed income instruments. So as I said, we could do a video of an hour on that, but let's focus on the main ones for Canadian investors. So when you buy a bond portfolio, what do you get? Well, first you get government bonds. So those could be federal government or provincial government bonds. So that's debt issued by the government, sold to investors to support government spending. Simple. Municipal bonds issued, that's debt issued by municipalities or counties to finance capital expenditures, including highways, bridges, schools. Corporate bonds, it's when a company borrows money from investors. A company gets the capital it needs, and you get a pre-established number of interest payments through a contract. And floating rate notes, so that's a debt instrument with a variable interest rate. So for example, you can buy bank loans. So company loans money to people, makes a bond with that and sells that. So you will, as an investor, if you buy the bond in the contract, sometimes it's going to say, well, if the Bank of Canada raises its rate, leading rate, or cuts its leading rate, then you're going to be getting more interest or less interest in the payment that you get. Or sometimes it can be benchmarked to a specific index, let's say the 3 months interest rate. And if rates move through time, then the payments that you'll be getting from this debt instrument will fluctuate through time also. So protects you against rising rates. So when you buy a Canadian bond portfolio, the typical one, what do you get? So if you will look at data from Morningstar, so the representative Canadian bond portfolio, in there you got 34.2% federal government debt. You get 37.2% provincial government debt. And why is provincial more popular? Because, well, you could argue that there's not that much more risk for an investor to lend money to the government, let's say of Ontario, of Alberta, compared to the federal government. It's pretty similar, but you do get a higher interest rate. So that's why it's so popular with portfolio managers. You get 2.2% municipal government debt, and you get 26.3% corps. So corps are also pretty popular. So this is what you get when you buy a typical Canadian portfolio. So if you want to learn more about bonds, you can follow us on Economy and Finance 101 section on the ia.ca/economy webpage. Over the next few months, we'll put more installments of this series. So we'll dig deeper into many topics related to the bond market. So be on the lookout for that. In the meantime, you can follow me on Twitter. You can connect with me on LinkedIn. So thank you very much for following us on a regular basis, and I'll see you in the next video.